In this week's video, we'll review the latest charts and data to help us answer the question, are stock market investors getting overconfident? We'll be moving quickly, so feel free to use the pause button on your video player. This is the NASDAQ 100 advanced decline line, where we take the number of advancing issues on the NASDAQ 100 index and we subtract the number of declining issues. You can see we had a very long period of consolidation and indecisiveness in here, mainly in calendar year 2022, but we didn't break out of the box until Q4 of 2023. This is the NASDAQ Technical Index. There's a little blurb about the index in the upper right-hand corner of your screen. This is the look that we want to avoid: 2007, this type of look in 2011, 2015, and late in 2021. And as you can see, this positive turn here in 2024, where we go on to eventually make a higher high, is similar to the bullish period in 2016 and the bullish period in 2013. How about the credit markets? You can see in the Dow Jones Corporate Bond Index, get a period of consolidation in here. When it resolves, it's near the major low that occurs in the S&P 500 and the NASDAQ in October of 2002. Similar situation here. Corporate bonds get drilled in the financial crisis. They eventually go on to make somewhat of a cup and handle pattern in here, and a new high is made in calendar year 2009. We have similar but still evolving improvement in December of 2024. This index has recaptured the 200-week moving average. You can see that concept a little more clearly if we switch over to a daily chart. This is January of 2024 here. You can see price action in corporate bonds in 2024 has been occurring above an upward sloping 200-day moving average. You can make an argument that this look in here is similar to this look in here after the major low in the stock market following the financial crisis. Clients and regular viewers know that leveraged loans is another way of saying riskier loans. This is what risk off looks like in here during COVID. This is your risk off look early in calendar year 2022 during the bear market. And this is the look in December of 2024. This is a weekly chart of the NASDAQ Composite. This is the waning momentum look that we would like to avoid, occurring late in calendar year 2021. You can see in December of 2024, we really don't have anything like this concerning window on the left side of your screen. This is PPO. It's a momentum oscillator. It's very similar to MACD. This is the bear market look that we want to avoid when the indicator is below the zero line. This would be a counter trend move within the context of an existing downtrend, because eventually we get a bearish cross, and all of this movement down here in the dot-com bust bear market is occurring below the zero line within the context of a downtrend. It's almost the polar opposite to what's been happening since we got back above the zero line early in 2023. And if we zoom in over here, this is the look that we have in the present day. Blue above red, that's a positive momentum look, and we're well above the zero line. This is a NASDAQ Composite daily as of the close on Thursday, December 5th. You can see we have a full bore bullish look even when we use relatively short moving averages from the 8-day in blue all the way out to the 50-day in gold. We've had this period of consolidation. We made a stand in August, and now we've broken above this consolidation box in here, and recent price action has been occurring above that box. Talked about this in the past. You can make an argument that this is a left shoulder here, this is a head here, and this is somewhat of a formation here of a right shoulder, and you would have an upward sloping and bullish neckline. The ratio of the NASDAQ Composite relative to the NYSE Composite, action in recent months has been occurring above an upward sloping 200-day moving average in red and above an upward sloping 50-day moving average in blue. It's important that we've gone on to exceed this high here on a closing basis. If we draw a trend line down here, step 1 would be breaking the trend line. Step 2 would be that this is a higher low here relative to this low, and step 3 would be a higher high exceeding this high here, just telling us probabilities are improving that that period is over and we're about to resume the existing uptrend. It's also important that the ratio here is back above this point here prior to the bear market in calendar year 2022. And if we come back over to the right side of the screen and we compare the look on December 5th, 2024 to where we were just a short time ago, we covered this version of the chart here on October 17th. You can see on October 17th, we were down here. We've had significant improvement in the ratio in recent weeks. NASDAQ composite relative to the S&P 500. Let's draw a line from this point to this point. It would be a downward sloping trend line. We would have exceeded that trend line here in 2023. During this entire period in here, we've not come anywhere near exceeding this low, so we've got a higher low in here more than once. If we can go on and exceed this high here, that would be an important step in terms of trying to resume the existing uptrend. Chart on your screen is dated December 5th. If we look at the same chart early in the session on Friday, December 6th, we can see it looks even better. We're trying to reestablish a full-bore bullish look using the 10-week, 20-week, and 40-week. NASDAQ 100 in isolation starts to consolidate in July of this year, but all of the consolidation occurs above an upward sloping 30-week, 40-week, and 50-week shown in green. We get a bullish breakout here where we exceed this high from July. We came back and tested that bullish breakout, and now we've gone on to print a higher high. Again, all of it occurring above upward sloping weekly moving averages with a nice bullish look on RSI holding above 50. You can pause your video player here. We've covered this chart numerous times. It's a favorable look on the monthly cloud of the NASDAQ 100. Checking all of the bullish boxes. It's in stark contrast to the look here during the rollover in the dot-com bust bear market, and in stark contrast to the look of the exact same chart in 2008 during the financial crisis. Chart speaks for itself. NYSE Composite has a full-bore bullish look when we look at the 50-day moving average in blue all the way out to the 250-day moving average in silver. We also have a similar and favorable long-term look on the monthly cloud of the NYSE Composite. Compare 2024 to the bullish period after the low in 2020, bullish period in 2012, bullish period in 1995, and 1991. Let's go over our weekly cloud checklist for XLK. The tech sector in isolation. Is green above price? It is. Is price above red? It is. Is blue above red? The answer is yes. Is price above the cloud? It is. And has the cloud flipped from red to green? It did a long time ago, back here in the second half of 2023, and all of this consolidation has been occurring above an upward sloping and bullish green cloud. It's also noteworthy that the weekly chart of tech has exceeded this high here from July of 2024. The broad Dow Jones Composite full-bore bullish look, December of 2024, we've got the 50-day moving average in blue, all the way down to the 250-day moving average in silver. All of this price action here occurring above this period of consolidation in the early stages of the 2022 bear market. This is the broad Dow Jones Composite average relative to the NASDAQ Composite. It's a weekly chart. You can see we have a downward sloping trend line on the ratio. All of the price action in calendar year 2024 in favor of the NASDAQ over the Dow Jones Composite. And all of this price action is still occurring below the 200-week moving average in red. Having said all of that, the 200-week moving average is trying to flatten out a little bit, so we have to keep an open mind about the ratio making a stand. But what we've done recently on December 5th is we've made a new multi-week low. Similar concepts here. The big chart compares the Dow Jones Composite to the NASDAQ Composite. Now we're comparing the same Dow Jones Composite average to the more narrow NASDAQ 100. Very similar analysis and similar takeaways. This is January of 2024. This is where we are in December of 2024. And if you prefer to look at the more narrow Dow Jones Industrials, affectionately known as the Dow, it too is in a relative downtrend when we compare it to the NASDAQ Composite. This is a daily chart. All of this price action in recent weeks and months occurring near a downward sloping 200-day moving average. When we show these relative charts, we're not showing these charts to take any position. We're simply monitoring and evaluating the chart in front of us. The chart in front of us of small caps IWM relative to SPY, it's a daily chart, has been making a series of lower highs. March of 2023, then we see a lower high in June of 2023, a lower high in the ratio in December of 2023, and then a lower high in July of 2024. There's been a lot of hype recently about small caps, and despite all of that, in early December of 2024, the ratio right here is nowhere near exceeding this high from July of 2024, and it's nowhere near exceeding the high from a year ago in December of 2023. That's the chart in front of us. If the ratio can get above the red line, the longer it stays above the red line, the more relevant it would become. And what would be very relevant, if you can clear this line here that's tied to this peak way back in 2021. But right now we have a chart that is sloping from the upper left to the lower right. And we know that we want to invest in things that go from the lower left to the upper right. Now, this version of a small cap IWM relative to SPY chart, it's a weekly chart, will help us keep an open mind potentially about a trend flip. You can see recent consolidation here is occurring very, very close to the cloud. That's discernibly different relative to what we had in calendar year 2023 and into 2024. So this is a waning downtrend. Having said all of that, price action is still occurring below a red cloud, and we still have a lot of boxes to check over here before we can say that the trend has flipped. Some improvement, enough to keep an open mind about a leadership flip, but we just don't have it yet. After the monthly labor report on Friday, December 6th, the market was pricing in an 87% probability that the Fed was going to cut rates again by 25 basis points on December 18th. All things being equal, that should be good for small caps. So if the market believes that there are additional rate cuts coming after the December meeting, then that would improve the odds of this chart flipping. We'll continue to take it day by day with an open mind. This chart helps us keep an open mind about consumer discretionary getting off the mat and flipping into a leadership position. This is a monthly cloud chart of XLY relative to SPY. The takeaway, the ratio is here in 2003. What once acted as resistance may now act as support over here in the present day in 2024, and dating all the way back to 2022 here, where the ratio held above these levels from 2003. We're not checking any bullish boxes yet, but the fact that the green span is back to the ratio tells you that this trend, this downtrend, is waning somewhat. This would be a logical area for this trend to reverse. We'll keep an open mind. You can also see down here, we have a subtle shift on monthly RSI. At the moment, it's above 50. We haven't done that since really late 2021, early 2022. This chart still has a lot of work to do, but there's reasons to pay attention with an open mind, and it is possible at some point that we could add some XLY to our allocations. Mid caps relative to large caps. S&P 400 mid cap relative to S&P 500 large cap. Here's the ratio roughly a year ago. If we draw a line between this point a year ago to the present day, it's a downward sloping trend line. If the lower right-hand corner of your screen can morph into something that looks more like this bullish turn here that occurred in 2022, then we would be more open to adding mid-caps to our portfolios. Right now, we have blue, the fastest moving average, the 30-week moving average on the bottom, and green, the slowest moving average, the 50-week on top. If we just looked at the moving averages in isolation, that's a full-bore bearish look. It's also noteworthy that the S&P 1500 is made up of the S&P 500, and then you add mid-caps, the S&P 400, and you add small caps, the S&P 600. So it's a very broad index. This is the look of the chart, the weekly chart on December 5th, 2024. It's difficult to think that the broad index that includes mid-caps and small caps is in anything other than a downtrend at this point. And if anything, the slope of the 200-week moving average is increasing in a bearish manner. If this chart down here starts to morph into something more like this, we would at least be open to a sharp counter trend rally, which is what occurred in 2020 and into early 2021. But we really don't even have that look yet, and this ratio here is well below where it was in 2023. The good news for stock market bulls is the relative chart doesn't look great for the S&P 1500, but the weekly chart with the 30, 40, and 50-week moving averages on December 5th looks fantastic, especially from a longer-term perspective. You have to keep an open mind about 100% normal and to be expected counter trends that occur within the context of an existing uptrend. Here's the waning momentum look that we would want to avoid on the weekly chart of the S&P 500. Look at Williams percent R over here below the center line or 50. You can see the present day really doesn't look anything like that with price above an upward sloping 40-week moving average in blue. Another chart that speaks for itself, S&P 500 daily, December 5th. That's the 50-day moving average in blue on top, the fastest moving average. The 200-day moving average in orange is on the bottom. We have a full-bore bullish look on December 5th. And once again, pullbacks within the context of an uptrend are 100% normal and to be expected. If the chart over here starts to morph into something more like this, early 2022, concerns would increase. Are institutions migrating to a defensive position, thinking that there's going to be a major event late in the year or after the first of the year? The answer is no. This is defensive staples on December 5th, XLP, relative to SPY. It's a weekly chart. You can see here, as the stock market is peaking in 2007, before that, this ratio turns up. This is a defensive turn where defensive XLP staples is outperforming the S&P. At a similar rising ratio here when things weren't going particularly well in the stock market in 2015 into early 2016. You can see the look of the ratio here in a risk-off mode, clearing the 200-week moving average over here, clearing the 200-week moving average in this area here, and clearing the 200-week moving average during the bear market in 2022. This is what we look like in 2024. And if we look at the same ratio on a monthly chart, it is noteworthy that this ratio started to rise in a concerning manner several months before the S&P 500 peaked. If you know your stock market history, the S&P 500 peaked in early to mid-October of 2007. This ratio started to rise following the close in June of 2007, and soon thereafter it exceeded a flattish turning up 50-month moving average in blue. Present day over here really doesn't look anything like that. We're making a new low, and we're well below a downward sloping 50-month moving average in blue. If the chart over here starts to morph into something like this, then we would learn something about shifting probabilities to the bearish side of the ledger. We'll quickly scroll through some relative charts. Remember, relative charts help us with weightings. This isn't about being bullish or bearish, or whether XLY looks good in isolation, or whether or not XLK looks good in isolation. This is about opportunity cost. This is XLY, consumer discretionary, relative to XLK, the tech sector for the S&P 500. It's a monthly chart. You can see on December 5th, 2024, the right side of your screen here would have a lot of work to do to have a bullish turn look similar to this turn here in 2010. The 8-month moving average all the way out to the 50-month moving average, this is a strong downtrend look, and typically this would take some time to reverse. Notice here when it starts to run, the ratio starts to run in 2010, look how close the fastest moving average is to the cluster when we shoot up. It's not really what we have in the present day. Just as an FYI, here are the top 20 holdings for XLY. You can pause your video player here. This is XLY relative to SPY. We have a downward sloping ratio dating back to December of 2021. And the last thing the ratio did was make an important lower low in 2024. To make a relatively important higher high, we would have to exceed this high back here, this high from 2023. And we also have potentially a lot of potential resistance in this area here for the ratio. A good step for XLY would be to clear this orange line and to have the orange line flatten out and turn up, because that would be different from what happened here in 2023 and different relative to what happened here in 2022. It's another example of an area where it'd be logical to potentially have a trend reversal. These two lines date all the way back to the financial crisis, and if we reversed here, especially if we could get out here, that would be noteworthy. Very similar concepts here. This is the equal weight S&P 500 relative to the tech sector. It hasn't made a lot of progress, and we're significantly lower relative to where this ratio was even earlier in 2024. Similar situation with the equal weight S&P 500 relative to SPY, standard weight S&P 500. And look where the ratio is in November of 2024, lower right-hand corner of your screen, relative to where it was even in April of this year. This is still a downward sloping trend line. We're not making any assumptions about what any of these charts are going to look like next week, in 3 weeks, or in 3 months. We trade the chart in front of us. We don't assume anything about the future, and we maintain maximum flexibility 100% of the time. Our concern should be that we want to get it right rather than trying to be right. We have long-term charts that look favorable from a probability perspective. The same can be said for shorter-term daily charts. If we look at some of the sentiment indicators in early December of 2024, it's extremely important that we don't get complacent and or overconfident in the coming days and weeks. Because we know, even within the context of the strongest secular trends, it is not unusual to see double-digit drawdowns from time to time. Given what we know today, our focus can be on the right side of the screen. But if we talk about volatility when things are going well, it's easier to ride out what could be 100% normal and to be expected volatility. Having said that, we don't want to make any assumptions about anything. And when things do start to deteriorate, inevitably, when things start to deteriorate, the objective CCM models will help us identify those turns and react in a prudent manner relative to probabilities. We have to keep in mind that drawdowns within the context of bear markets can be devastating. There's 10 cases in U.S. stock market history or hypothetically $1 million account would have eroded down to somewhere around $450,000 to $500,000. Given what we know today, nothing like that appears to be imminent, but it's always healthy to understand stock market history. If it happened before, it can happen again. And we all know the only way that we can use all of this effectively, and the only way that we can identify a bearish shift like this at some point in the future, is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.